we define account risk. What does that mean? What does it mean to define account risk? So you need to determine how much you're going to risk of your capital to each individual position. So I'm just going to use some round numbers. Some people are trading with $3,000 and trading with a small account is fine. Some people are trading with $100,000. It doesn't matter. I'm going to use an example that I actually teach in our bootcamp. And if you want to learn more about the bootcamp, click the link below the video. Let's say you have $30,000. We just keep it as a simple number. So again, don't let the numbers overwhelm you. It doesn't make a difference. So let's say you have $30,000 in your account. Now, some people will trade that entire $30,000 and allocate that buying power to one position. And there's nothing wrong with that if you have experience, if you understand risk, if you understand probability, if you understand how to make money. A more conservative way to allocate money to the market is to break up that $30,000 into multiple positions. So when we're talking about defining account risk, what we're actually talking about is how much of your total capital is going to go into each position. So essentially what that means is if we have $30,000, we would allocate, for argument's sake, $10,000 per position. So you're never fully exposed to one idea. So you're actually spreading out the probability and the risk of your position because one position is not dominating all of your buying power. Now, there's two sides to that. The first side is the greed kicks in and you start to say, well, I want all of my money in one idea because if that idea is really good, I could make more money. And emotionally, that sounds correct. But logically, you shouldn't be taking that much risk. And I don't take that much risk unless you have more experience. You have to have more experience to understand when to size up, when to size down. So it is a smarter decision to allocate that same $30,000 to three positions. So you technically, in your defining your account risk, it would be $10,000, $10,000, $10,000. So you're spreading out your allocation of that hard-earned money you have into three different ideas. So remember what we talked about before with probability. Probability is it's going to happen more often than not. And that implies you need a sample size. You need 5 trades, you need 10 trades, you need 20 trades to allow the probability to work out. So whether it's 60% or 50% or 30% or 80%, probability means over a sample size. So if you only take one trade, you're not allowing the probability. You're putting all of your eggs in one basket. And there's nothing wrong with that if you understand what we're going to talk about going forward. But if you're just learning, especially if you're a stock market beginner, you want to understand how to allocate your money to a couple of different positions. So that is the first step. The first step is defining account risk, account size risk. So just in that example, just to give you stuff to write down on your legal pad, let's say you have 10,000, you break it up into 3 different positions, which now means that you will have 3 different possible positions of $10,000 per trade. So you can actually allocate $10,000 to an Apple trade, $10,000 to NEO, electric vehicle stock, okay, whatever it happens to be, okay? Next, we're going to walk over to the next part of the equation, which is defining